It's Midcap Radar time on CNBC-TV18 as we count down to the final 2 hours of Monday's trading session. I'm Hormuz Fatakia and with me is Vivek Iyer. Vivek, good afternoon. The indices were trying to attempt a recovery, but now they are also firmly in the red, 250 points down on the Nifty. But the actual pain, though, is in the broader markets.
Absolutely right. The name of the show is Midcap Radar, and the midcap and the small cap space are the set of indices that are seeing the most amount of pain. Let's start off with the top headlines. Quite a packed show is what we have for you today. Good afternoon. Welcome to Midcap Radar. The top headlines for the day. Stocks see a broad-based sell-off with very few counters managing a green tick. Industrials and utilities are the biggest drags.
Laurus Labs falls over 10% on concerns related to its antiretroviral business after the US withdraws from the World Health Organization, possibly impacting funding relief for AIDS, impacting its ARV medications.
DLF shares surge over 5% after the company reported its best ever quarterly new sales booking on a high base. The real estate players' Q3 net profit jumped over 61% on a year-on-year basis.
Credit Access Grameen tanked as much as 17% but recovered from the lows after the company once again cut its guidance for the full year. AU Small Finance Bank also is down over 6% after cutting its FY25 loan growth guidance from 20% from 25% earlier.
CDSL declines almost 10% following its Q3 earnings. Operating income stood at Rs 221 crore versus 248 crore on a year-on-year basis, and its EBITDA fell by 37% from the September quarter to 146 crore. Well, good afternoon. Welcome to Midcap Radar. Like we just said, it's the broader end of the markets that are seeing the most amount of pain. The pharma pack is taking it on the chin today. In fact, the pharma index, the top laggard, with few of the names like Laurus Labs, Strides Pharma, seeing the brunt of the selling pressure. But this is our special segment, Midcap Movers. Vamakshi is standing by the wall to take us to the midcaps that are buzzing in today's trading session.
Well, good afternoon, Vivek. The mid-cap index and overall the broader indices, in fact, are under fair bit of pressure today. Just to put it out there, nearly 20 stocks in the mid-cap index have touched 52-week lows today. Let's bring up the list of the stocks that are declining in trade today. That includes Anant Raj, Laurus Labs, NetWeb, as well as Tejas Networks. Now, keep in mind that Anant Raj has seen the biggest fall since June 4, which is the election day. Laurus Labs and Tejas Networks both are seeing the biggest intraday retreat since 2020, and NetWeb has seen the biggest fall on record. Apart from that, on the flip side, let's look at the list of the stocks that are gaining momentum in such a weak market. That includes Sobha. That stock is up nearly 8%. Cyient again up nearly 4%. Yes Bank and Gujarat Ambuja Exports are some other counters that are gaining in trade today. Let's also look at some stocks that are reacting to the numbers. First, let us look at the stocks that are up in trade. Bank of India, Central Bank of India, these PSU banks are up in trade nearly 6%. In fact, we also have DAM Capital that reported its numbers over the weekend. It's a new kid on the block. That stock is up. DCB Bank is another counter that is surging by almost 5%. There are some other counters that are declining on the back of weak set of numbers as well. That includes IDFC First Bank, CDSL, Credit Access Grameen, as well as Ugro Capital. Keep in mind that Credit Access Grameen has seen the biggest intraday fall since March 18, 2020. Lastly, let's look at the stocks that are moving on the back of strong volumes as well. All of these counters, TBO Tech, that stock is down nearly 7%. ZF Commercial, Supreme Industries, as well as Inox India are some of the other counters that are down and out in trade today.
Makshi, thanks a lot for that. By the way, Canara Bank's numbers flashing on your screen. Some improvement seen in its asset quality on a sequential basis as we speak for Canara Bank. Keep an eye out on that. Its gross NPA for the quarter is around 35,000 crore rupees compared to 37,000 crores in the previous quarter. The net NPA too has seen a slight reduction from almost 9,800 crores to 9,000 crores at the end of the December quarter. We'll keep an eye out on the numbers in percentage terms as well. Now, gross NPA for the quarter is at 3.34% from 3.37 in the 3.73 in the September quarter, while the net NPA number is at 0.89% from 0.99% earlier. So a slight improvement seen in the asset quality for Canara Bank, and the stock seeing some volatile moves after the results announcement. Also pull up Adani Wilmar before we take that break, because just a few minutes ago that too came out with its results, and the EBITDA was up 57% on a year-on-year basis. Margins also saw an expansion compared to last year of almost around 80 basis points, and that is reflecting in the price as well. Almost at the highest point of the day is Adani Wilmar, 3.5% higher Their earnings reactions will continue through the day, but we take a short break. But before we do that, it's time for Growth Code, which is an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, in a special interview, CNBC-TV18's Prashant Nair interviewed SEBI's whole-time member Anant Narayan and asked him about the risks involved in the derivatives market.
You've done a fair bit in terms of weekly options and other things. Or is that work in progress still? Is this going to continue to evolve, and we will see more sort of regulation and efforts to make people aware of the risks in this kind of activity?
You know, derivatives aid in price discovery. They give you depth in the market. They allow for risk management. They allow for trading, all of those things. And we do need all of these things for capital formation. So let it be very clear, SEBI is not against derivatives. We did have a problem though on two fronts. One was our first principal mandate is investor protection. And it was very clear from the two research reports that I quoted to you that small investors were losing out and that we cannot close our eyes to it. While we are a disclosure-based regime, we are not an nanny state. At the same time, we can't allow this to continue for a very, very long time. That is one particular issue. The second issue was we also saw a fair amount of over trading and therefore increase in system-wide risk, particularly on expiry days. And when we spoke to our market participants and we consulted with them, what we realized is that the core issue really is not across the spectrum of derivatives, but specifically in the area of index options trading on expiry day, right? So out of the 6 steps that we announced in October, 5 of them were clearly and squarely directed at trying to curtail this question of over trading in index options on expiry day. Now, we haven't directly tried to address investor protection, but by this oblique route of trying to bring down over trading on that expiry day in index options, we think that will have some kind of a benefit for investor protection as well. We've taken the first set of steps. We are still looking at how the impact is kind of playing out.
Welcome back to Midcap Radar. Well, shifting focus to SBFC Finance, the company saw its assets under management surge 30% on a year-on-year basis, while net interest margin has improved sequentially. Asset quality has been stable. To discuss more on this, we are joined by Mahesh Dayani, who is the Chief Business Officer at SBFC Finance. Thank you so much, Mr. Dayani, for joining us. In a quarter where a lot of the lenders have seen significant amount of pain, you've managed to come through unscathed in this particular quarter. But as far as key metrics are concerned, Q4 FY26, how are you looking at loan growth? How are you looking at net interest margins? We understand you've guided for a bit of moderation as far as margins are concerned.
So we've always been guiding that the growth is going to be anything between 5 to 7% on a quarter basis, and that's what we've been delivering. This quarter was no different. We grew by almost 6%, and all through the cycles, probably you'll see us delivering on the higher end on a positive cycle. When you do see an environment which is slightly a bit challenging, probably you'll see us delivering more towards the lower end of our guidance. But largely what we've said is that we will move between 5 to 7% on a growth. And even on the last quarter basis, we don't see that guidance changing. Also, what's happened for us is we're coming off from a small base. So clearly it doesn't really matter how the overall economic environment moves and how the market share moves. We're in terms of assets close to around 8,100 odd crores. And we're fairly confident that if we continue to grow at 5 to 7 odd %, you compound at almost 24%, which practically means that you double every 3 years. So we're pretty comfortable with that range of growth.
Mr. Dayani, good afternoon. Thank you for joining in. You've been fairly, your rejection rates in terms of applications are now increasing. Are you being cautious on the lending side because your disbursements too for the quarter were down almost 3% from last year, although they were up sequentially? But what's the stance being when it comes to lending?
So what's happened is at the beginning of the year, we had, we did give a sign of caution with respect to the applications that were coming in. And while it was pretty early days, we were looking at the leverage moving up significantly. So what we said is that we are going to be tightening a bit of our filters, which we did in quarter 1. And we did follow it up in the beginning of quarter 3 because we didn't see a significant shift in behavior. And despite CIBIL scores being positive, I guess the inquiries continued to increase. Incomes we didn't see move up significantly, which would justify higher exposure. So that explains why our disbursal numbers were stable. Although our originations have moved up significantly, so we originate close to around 20 odd thousand applications in a quarter, but our approval rates did dip. That range is anything between 6 to 7 odd percent. If you were to budget for it, that's roughly around 1,000 in a quarter, which is at an average ticket size of 10 lakhs, adds up to almost 100 crores. So that's something that we are consciously leaving on the table. And that's a conscious growth that we are saying that we wouldn't want to probably digest, because at some point of time, it's going to come back and bite you in terms of the credit cost.
Understood that. So with taking that as the cue, how do you see credit costs pan out for you going forward? Much lower compared to what your peers are facing. And also, in the call you've guided that you'll be going slow in two states especially. So which are the states that are seeing increased stress in terms of collection? And could you name them and give us some broad indicators as to Q4 and FY26? How do you see that panning out?
So answering your first question, the credit cost, we've been range bound between 80 basis points to 100 basis points. In an environment currently that we are in, we would be around 100 to 110 basis points. We don't expect that to move up significantly. On the secured side, that's largely been the range. Unsecured has a different outcome, but we are largely a secured company. It's either secured by property or gold. So we're pretty comfortable estimating our averages anything between 80 to 100 or 110 basis points, nothing more. As far as the states are concerned, I think there were two states where the overall bureau numbers weren't very positive. One was obviously Bengal, the second one was Punjab. And that's something that we've gone a little slow because the overall bureau scores haven't been too great on the secured side. So there we're being a little cautious even from a quarter 4 perspective.
Mr. Dayani, your AUMs were growing at 30% this quarter. Do you expect that growth rate to sustain for the full year as well? And do you expect this trend to continue into FY26 as well?
So we said that whether it's sunshine or rain, we'll continue to be on 5 to 7, and that hopefully should contribute anything between 25 to 30% even from a next year perspective.
Thank you so much, sir, for joining us, giving us a sense of how business panned by. We'd love to have had a longer chat with you, but due to paucity of time, we'll cut this particular interview short. Let's now slip into a short break. Management of Mindspace REIT joins us next to discuss their third quarter performance and more.
Welcome back. Continuing with corporate conversations, and Mindspace REIT is the next management that is joining us to discuss the quarter gone by and the outlook going forward. Ramesh Nair, the CEO, is joining in. Ramesh, good afternoon. Thank you for joining in. Your revenue from operations were up around 7.5% from last year. Now, can you break down the key drivers for this growth? And do you expect this 7.5% to say around about 8-10% revenue growth trend to continue going forward as well?
Thanks, Vivek and Homas, for having me on the show. If I rewind back 1 year back, what are the big concerns about REITs? First was distribution growth. We have fixed it. We have shown distribution growth of around 11%. Price appreciation, I was just checking the numbers. Last 12 months, our appreciation has been 17%. You add dividends of around 6%. So we're talking of a product which is around 23% in terms of total returns. SEZ vacancy used to be an uncertainty a while back. With the government allowing flow-wise demarcation, that's behind us. Work from home, which was a challenge 2 years back, that's again been fixed. In a portfolio like ours, what we're seeing is almost all our parks are more than 75% plus attendance. Back then, I remember when the government change had happened in Telangana, There was also a concern if there would be any worries regarding the overall political continuity in terms of stability, which we have seen because Hyderabad again has seen record numbers in terms of office leasing. So overall, the market is looking phenomenal. The leasing numbers are through the roof. Market is every quarter when I read the IPC reports, I see new records being broken again and again, both on net and gross leasing.
Mr. Nair, that gives us very good perspective to ask our next question. So currently, what is the total lease or total area under leasing? FY26, FY27, what is the proportion of area that will be added on? Can you also help us with a DPU guidance? We understand that you are regulated, to give out 90% of the proceeds. But what is the kind of guidance that you are going ahead and helping investors with? We understand that with higher leasing, you will be able to give out a higher dividend payout.
So right now our occupancy is 91.5%. By end of this financial year, which is March 31st, we hope the occupancy will go up to around the 92.5 to 93% mark. We are quite confident that we will start seeing distribution growth happening. We typically don't give guidance on distribution. We're also looking at a ROFO asset. We are looking at a third-party acquisition. Any acquisition we do will definitely be a strategic milestone for us in our growth journey. We are still looking at expanding our footprint in the key markets, committed to invest in high quality premium potential assets. And I think this ROFO and this third party acquisition will be a step in the right direction.
What about data centers, Ramesh? Your delivery of your second data center in Airoli was well ahead of schedule. What's the expansion plan in that space, and how much of a contributor to your business do you expect this to become over the medium to long term?
So what we're seeing in the country is every year we are seeing around 250 megawatt of capacity addition in the country. For us, we are extremely well placed to capture the demand. We have 5 data centers in our portfolio, out of which 2 which is already been delivered. These 5 data centers would be 285 megawatt capacity. This is also 1.7 million square feet of our portfolio. It helps us because we have long-term leases. It helps diversify our tenant base. It helps diversify our tenant risks involved with tenants. These data centers typically give us longer lock-ins. We're very happy to have delivered our second data center, 315,000 square feet, 2 months ahead of schedule.
Right. Mr. Nair, a couple of quick questions. First up, what is the current debt level? What is the level of debt you will take on to go ahead and make these acquisitions that you spoke about? The other question is, at the end of FY25, how many leases are expiring? Have there been any that have already been renewed? And are these happening at higher tenancy rates?
So our current debt is around the 7,000 crore mark. Our LTVs is at a very healthy, lowest in the industry at 22.6%. We would be doing these ROFO acquisitions and third-party acquisitions mainly through debt. In a portfolio of our size, we have close to 35 million square feet of 27 million square feet is ready and completed. What we typically see in a year is 2 to 2.5 million square feet of leases which come up for expiries. We try and see if we could get at least 50% of them to renew, and that balance 50%, we try and get newer clients. Many a times we've seen that when some of the clients who signed up long back, maybe 9 years back, 10 years back, when the markets weren't as hot as it is right now, when some of these tenants leave, it gives us those mark-to-market opportunity. Just in this quarter, the quarter we just got over, releasing spread was 26.4%, which means when a tenant vacated us and we gave it to a new tenant, we were getting 26% more rentals. So in a portfolio of this size, tenants vacating is part and parcel of the business.
All right, Ramesh, thank you so much for sparing time and joining us. Wish you good luck for the rest of the year as well. That is the management there of Mindspace Business Park REIT, the stock doing fairly okay in a market that is otherwise full of red on the screen. By the way, numbers from ACC were just reported a few minutes ago. The third quarter volume growth at 21%, which is the highest ever that it has reported in a quarter, is for ACC. So that's the big number to watch out for in terms of ACC, the volume growth figure. The stock, though, continues to remain choppy, around 1.5% lower as we speak for now. The revenues also includes a grant of 720 crore compared to a 59 crore grant that has come in the base quarter. Other income too has seen a substantial surge that has aided the bottom line, and that is also because of a favorable income tax order that has come in for the company. So numbers from ACC to watch out for, the stock looking to recover from the lows of the day. But with that, it's a wrap on this edition of Midcap Radar. From Vivek, me and the team that put this show together, thank you so much for watching. Your stocks and a slew of other earnings on the other side.
Hey, thank you for watching this on CNBC TV18. Hope you liked it. For more such interesting news and updates, follow CNBC TV18 on all the social media platforms.